How exactly can markets stay constructive in the coming weeks?
I think you're absolutely right. I think we're both looking into, obviously, a number of vaccine news that's going to come in more positive. By the end of the second quarter, we're going to have, in our estimate, 70% of the US population with first dose of the vaccine. In Europe, around 40%. And that ultimately means that we think that the second quarter is going to be absolutely transformational in terms of growth, some growth rates that I expect to be some of the strongest of my career. And I think that leads strongly into equity markets. And even if Jay Powell and the rest of the Fed told us mid last week that they're going to let inflation run a little bit longer, they're also giving the equity markets the goodie of keeping short-term rates close to zero for an extended period of time. Earnings estimates continue to be revised higher in places like the US, and this is all of the, in its entirety, a strong backdrop for global equity markets, and in particular some of the reflationary trades.
So I look at the reflationary trades, I look at the S&P 500, I look at some of the value-oriented sectors in the U.S. markets, and it's translating to other parts around the world as well. I guess my question mark is, how much of the optimism about the rebound has already been priced into the market right now, ever since the vaccine headlines came out in November, late October, early November? The markets have been off to the races. Isn't it all factored in right now, or is there still more to go?
We think there's more to go. So we think when we look at it across the different sectors, it's energy and financials, small caps as well. So if we look at something like small cap, as an example, it's trading at a 2 standard deviation cheap to the rest of the market. When we look at value, it has certainly caught up, and it's basically where it was a year ago, but a significant underperformance over the last decade to the growth names on the back of falling yields, essentially. And if we look at something, again, more concretely like financials, it's trading at also a 2 standard deviation cheap to the broader US and European market. It's supported by not only higher yields as a bit of an insulation against high inflation rates, but it's also supported by falling non-performing loans. We're seeing earnings revisions going significantly upwards on the back of falling provisions. So all of which are factors which we think are both an interesting investment case in itself, but also for our portfolio context, for a lot of our wealth management clients, something that insulates from what we think is at the moment not a risk that's related to growth in the markets, but rather to an overshoot in inflation.
Let's talk about, Mark, those wealth management clients that you have, fairly affluent and whatnot. If you look at the way interest rates have developed over the course of the past 2 to 3 months, has it changed at all the view of your clients about where they should be allocating capital? Has the pullback in the bond market made an attractive entry point for certain parts in credit, perhaps corporate credit on high yield or investment grade? Are people still looking at the equity markets for most of those returns? What about the hunt for yield? The interest rate picture has changed so many parts of the market trade so far this year.
That's absolutely right. We've been recommending our clients for longer to be out of cash, high grade, and also investment grade bonds where we don't have that kind of insulation from the move up in yields and where there's a high sensitivity to rising inflation rates. If we look at the US high yield markets, we have credit spreads of around 3.5%, and we see that overall the sensitivity to these rising yields and inflation expectation is relatively low because the strong growth, inflation, higher energy prices basically lean into a strong fundamental backdrop for, in particular, something like US high yield or also Asian high yield, which is something that our clients have been zooming in on for a while, where you today get yield levels of close to 7% in US dollars. So it is a fundamentally different backdrop for many of our investors who have both shifted towards the reflationary trades, but also within the fixed income segment, looking for both things like US high yield or senior loans, where you get significant more attractive yields and investment composition than you do in your higher rated bonds.
Shepard Smith here. Thanks for watching CNBC on YouTube.